Welcome to this deep dive. Our mission today, really try and make sense of a pretty perplexing earnings call. We're looking at TriNet, that's ticker TNET, specifically their Q3 2025 results. Because, if you just glanced at the headlines, you'd think everything was rosy. They absolutely smashed the adjusted EPS consensus. But then you look at the stock reaction, and it was rough. A big drop during the main trading session, totally erasing any early gains. Investors were clearly skeptical. So, yeah, that's our job today. Untangle this. What drove the good financials, but maybe more importantly, what drove that sell-off? Let's get into the numbers.
Yeah, that divergence is really the core of it, isn't it? You have to look past that shiny headline number almost immediately. So, okay, the beat itself, TriNet delivered $1.11 in non-GAAP or adjusted EPS. That just blew away the street's expectation. Consensus was around 72 cents, give or take.
Wow, okay. $1.11 versus 72 cents.
Yeah.
That's a huge beat.
It is. And GAAP EPS came in at 37 cents. Revenue also managed a slight beat, came in at about $1.23 billion, just a hair over the $1.22 billion people were looking for. But, and this is the big, but total revenue was actually down 2% compared to last year.
Hang on. They beat expectations for this quarter, but the overall pie is shrinking year over year. For a PEO, isn't that kind of a fundamental problem?
Yeah.
Their whole model is built on employee count.
That's exactly the tension. And you see it in the profitability metrics, too. Adjusted EBITDA, that's, a proxy for cash operating profit, was $100 million. That's an 8.2% margin, which sounds okay, maybe, until you see last year's number. $109 million, an 8.8% margin. So they're making a less operating cash on less revenue. The beat came from somewhere else, likely cost control.
And the root cause of that revenue decline and probably the market freak out seems pretty clear.
Yeah.
It's volume, right? The worksite employees, the WSEs.
Bingo. Average WSEs dropped roughly 6% year over year. That's a significant fall.
6%, wow.
Yeah, total WSEs landed around 335,000. And if you zoom in on their main PEO business, the co-employed workers that decline was even sharper, down 9%.
Ouch. 9% on the core business. So when a company's main growth engine is the number of people they service, seeing a 6% overall drop, let alone 9% in the core, I can see why investors got nervous.
Definitely signals some structural headwinds there.
So effectively, management's message was, look, our finances are under control, maybe even improving on some metrics, but fewer customers are using us. Which brings us straight to the why. Management seems to argue this pain was necessary.
That's the narrative they're pushing, that this was part of a deliberate, maybe painful strategy. They focus hard on cost controls and, critically, on benefit repricing. They pretty much confirmed they're through the worst of what they called the heavy lift on repricing their health plan.
The heavy lift being jacking up prices.
Essentially, yes. They rolled out cumulative health plan increases around 10.5% per enrolled member. Their argument is that this was vital, to get aligned with these stubbornly high healthcare cost trends. They're saying it puts them ahead of the curve compared to PEO competitors who might still have to swallow those costs later.
Okay, maybe prudent long-term planning, but based on those volume numbers you just gave,
Yeah.
It sounds like it caused some serious short-term damage. That kind of price hike must have hit retention hard.
Oh, absolutely. You look at the reasons clients gave for leaving in Q3, health plan pricing was number one, the number one reason.
Number one. Wasn't it much lower before?
Yep. Just a year ago, it was only the fourth biggest reason. So that 10.5% increase, it clearly became the main driver pushing clients out the door this quarter.
So they sacrificed volume for pricing discipline.
That's the trade-off. The whole point of this repricing was to fix their margins, specifically by getting their insurance cost ratio, the ICR, back into line. That's the slice of insurance revenue they pay out in claims. And this pricing discipline, they believe, sets them up to get that ICR back into their target long-term range, 87% to 90% sometime in 2026. And because that internal cost structure looks better, management now feels confident enough to say that the full year 2025 adjusted EPS is heading towards the high end of their previous guidance range, which was pretty wide at $3.25 to $4.75.
So better profitability per remaining client, basically. And it wasn't just insurance costs they tackled, right? You mentioned broader cost control.
Correct. Operating expenses were down 2% year over year, and that's the third quarter in a row they've managed that. They put it down to using tech smarter and talent optimization, which usually means becoming leaner.
Okay, but let's circle back to the volume problem. It wasn't just clients leaving because of price, was it? What about hiring by their existing clients?
Right, the customer-initiated employment, or CIE. That tracks hiring activity within their client base. And in Q3, it was flat compared to last year.
Flat sounds Not great.
Well, yeah. Year to date, there's been some improvement, mostly because layoffs slowed down in tech and financial services. But flat in Q3 is actually a net negative. Think about it. Q3 usually has some seasonal workers leaving, summer hires, and whatnot. So if client hiring is only flat against that normal seasonal drop-off, the net change in employees is still negative. It feeds into that overall 6 per 2 in WSE decline.
Gotcha. That makes the timing crucial. Management said they think the pricing gap with competitors is closing now. And they mentioned a specific date, January 2026.
Yeah, they flagged January 2026 as the largest remaining sort of catch-up renewal cycle. The implication is that once that group renews, maybe with more moderate increases, the really big pricing shocks should be behind them.
So the hope is survive January 26 without another mass exodus, and things might start to stabilize on the volume front.
That seems to be the bet, and their full-year guidance kind of reflects that tension. They expect revenue near the midpoint of their $5 billion target, but they're guiding margins and EPS towards the top half or even the high end of the ranges. Profitability over growth, for now.
But they can't just rely on cost cuts and hope volume comes back.
Yeah.
How do they plan to actually reignite WSE growth once this pricing pain eases off? Do they talk about specific initiatives?
They did. They're leaning into two main areas, partnerships and tech.
Okay, partnerships first.
They're really pushing their preferred broker program, and they said it's already showing results, driving double-digit growth in RFPs, requests for proposals. So using outside brokers to bring in more leads seems to be working.
And on the tech side, sounded like they were making a big push with AI to stand out. Better service, maybe stickier clients.
Absolutely. They announced this new AI suite, described as human in the loop. It includes things like a TriNet Assistant for quick HR questions, a dynamic dashboard, and even a virtual health assistant through a partnership with a company called Healthee. The goal seems pretty clear. Make the service much better, much easier for SMBs to use, which hopefully justifies the price point and helps fix those retention numbers that look so bad this quarter. Make the platform stickier.
Which brings us right back to why the market reacted so negatively. If they're controlling costs, fixing margins, rolling out new tech, why the big sell-off? It seems investors just couldn't look past the current volume weakness and maybe the macro picture.
I think that's spot on. It boils down to pessimism about the macro environment and looking closely at how that revenue declined. Management themselves pointed to the tough hiring environment for small to medium businesses, the SMBs. When SMBs get cautious and stop hiring, it's a direct hit to a PEO like TriNet that relies on WSE growth.
And we should probably break down that revenue decline a bit more, right?
Yeah.
Specifically the professional services revenue, the PSR. That's the fee income, not the insurance pass-through.
Exactly. PSR was down 8% year over year, came in at $169 million. And that's a key number because PSR is generally higher margin revenue. The drop had two causes. One, obviously, the lower WSE volumes we've been talking about. But two, there was also this sort of one-off $5 million headwind. They discontinued a specific tech fee for a client that they recognized back in Q3 2024.
So a non-recurring item that made the underlying PSR decline look a bit worse this quarter.
Precisely. That $5 million noise should fade in Q4, but it definitely amplified the perception of volume weakness in Q3.
Were there any bright spots helping offset that core PEO volume drop? Anything else bringing in revenue?
Well, yeah, they mentioned their ASO, the administrative services only offering. Conversion rates there were better than they expected.
ASO being where clients just outsource the admin tasks but don't do the full co-employment thing?
Right. It's a lighter touch, lower margin. Generally, they price it maybe simply to $75 per member per month. But it's something. It helps mitigate the PEO decline, provides a bridge for some clients. We should probably also mention interest income. It got a boost this quarter from higher cash balances, partly due to the timing of some tax refunds. Management actually called out about $3 million of that interest income as being unusual, sort of catch-up interest.
So another temporary boost that helped the Q3 bottom line but isn't really sustainable helps explain the market's caution about the quality of that big EPS beat.
Exactly. And one last point, maybe signaling a shift, they named a new CFO. Mala Murthy, formerly the CFO at Teladoc, is coming in as EVP and CFO starting November 28th.
Interesting. Bringing in someone with that kind of background, especially from a tech-enabled health company like Teladoc, maybe signals a stronger focus on shoring up the financials and plotting that path back to profitable growth, addressing investor concerns, perhaps.
Could be. It suggests a serious focus on financial discipline and maybe the strategic direction moving forward.
Okay, so summing it up, it really is this great divergence, isn't it? You've got strong execution internally, margins, costs, even service quality. They said their net promoter score hit an all-time high. But that's clashing head-on with the external reality. That 6% WSE decline, driven by pricing actions and a sluggish SMB hiring market, investors seem fixated on the volume, full stop.
It's internal strength versus external demand weakness, basically.
And management seems to think the worst of the internal pain, the repricing, is mostly done. They're pointing to January 2026 as the next hurdle. So the question for you listening is, do you buy that narrative? Is the worst really over?
Okay, before we speculate wildly, this is where we absolutely have to pause for the disclaimer. Everything we discuss here, especially in this next bit, is just for informational and entertainment purposes. We're summarizing what the company said and what the market did. It is absolutely not financial advice. Please always do your own research, your own due diligence before making any investment decisions. Okay.
Disclaimer delivered. Let's hear this outrageous but plausible trade idea based on everything we've just discussed. Lay out the thesis.
All right. The thesis is basically this. The market reaction, that big stock drop, the negativity. It suggests investors have already priced in the pain. They've priced in the WSE decline. They've priced in the repricing impact. The pessimism is arguably baked in. So the real uncertainty now, the key question, is whether management is actually right about that pricing gap closing by early 2026. Is the worst of the competitive pressure from their price hikes truly behind them?
So the trade is betting on management being right about the timing.
Kind of. It's a tactical bet on an inflection point happening maybe sooner or more smoothly than the market expects. You could structure it maybe as a calendar spread or perhaps just long-dated call options focusing on Q1 or Q2 of 2026.
Okay. Betting on a 2026 stabilization, what makes that particularly outrageous right now?
The outrageous part is making that bet today, given the ongoing cloud over the SMB economy. You're essentially betting against that macro pessimism. You're betting that the January 2026 renewal cycle, that last major catch-up set, as they called it, goes okay, no disaster, and that the new AI tools in the broker program actually start to stabilize WSE trends faster than the current gloomy valuation implies. You're buying into the idea that their operational improvements and margin control are real, and betting that volume will eventually follow, even if the macro stays choppy. It's a bet on the moat widening, essentially.
That's a really interesting way to frame the potential turning point for the stock. Okay, we're nearing the end of this deep dive. It's really been a story defined by that stark contrast, hasn't it? You've got this high-end EPS guidance built on some genuinely impressive margin and cost work. But it's set against that backdrop of falling WSE volumes thanks to their own pricing actions and the soft SMB environment. They're tidying the house, but fewer people are living in it right now.
Yeah, that's the core tension.
So the final thought for you to consider, they've invested a lot in this new AI stuff, the TriNet Assistant, the health tools, they've fixed the margins. Will that combination, better service, smarter tech, solid financials, be enough to really differentiate them? Enough to widen that competitive moat and get WSEs growing again in 2026, even if the overall SMB market stays kind of sluggish? Is TriNet becoming more of a tech-enabled service platform? Or is it still just a traditional PEO fighting uphill?
Well, I guess only time, and maybe that January 2026 renewal data will give us the real answer. And one last time, please remember, none of this was financial advice.
Definitely not. Thanks for joining us for this breakdown of the TriNet call. We'll get you on the next deep dive.